Jeffrey Gundlach sounds the alarm. The Fed's next moves could redraw the lines of the yield curve and your investments. Will shock Fed moves create surprise opportunities in mortgage-backed securities? Wait for Gundlach's final tip on what asset class he's betting on next.
All right, well, I'm glad we have continued the tradition. I really hit on that at the top. December is not a foregone conclusion. Far from it. Chair Powell went out of his way to say that.
Yeah, you're right. Yeah, you're right. In fact, that was going to be my phrase of the press conference. So you're on the same page that I am. Not a foregone conclusion. And then he reinforced that with far from it. And then he went back to that theme a little bit later on in the Q&A when he said, what do you do if you're driving through a fog? You slow down, which is kind of sounds to me like if we don't have any more data, I think that we need to price out to a certain extent what was an assumption by the market that there was going to be almost with 90+% certainty a cut in December. And I would say that has been reversed or should be reversed. It's begun to be reversed, but I think it should be reversed fairly substantially. I might even put it at 50-50 when he says that there's far from a foregone conclusion. I saw in the pregame before the Fed announcements, I saw Rick Santelli talk about how the 2-year Treasury and the 10-year Treasury haven't changed since the last meeting, and he's right about that. I'd amplify that point, though, that the 2-year Treasury is down since before the Fed started cutting, or the day after the Fed's first rate cut back in September of last year. The 2-year Treasury rate is down all of 5 basis points. That's it. And the Fed has cut rates 150 basis points. Meanwhile, the 10-year Treasury rate and the long-term bond rate are up since the first rate cut, steepening out the yield curve. And I think that one thing I've been contextualizing all through these Fed cycles is that the Fed tends to gravitate towards the 2-year Treasury yield with the Fed funds rate. So back in September of last year, there was about 150 basis points spread between the Fed funds rate and the 2-year Treasury, but the 2-year Treasury being much lower. But now that the Fed's brought the rates down, they're very much in the context of the 2-year Treasury now, with only about a quarter point difference between the two. So I think what's really happened here, of course, is that we've seen tremendous rallies in financial assets this year. I mean, everyone's focusing on the stock market in the United States, but Europe's done well as well. The emerging markets have done even better. And bonds have done surprisingly well versus most people's expectations. This is actually, for the investment-grade bond index that is most commonly followed, out of the last 49 years, this is the 11th best year, following some pretty terrible years, particularly in 2022. So I think that we're looking at the possibility for a steeper yield curve. I think it's interesting that they're saying that they're going to let the maturing mortgage-backed securities, they're going to reinvest them in T-bills. And he mentioned in his comments, Jay Powell, that they want to reduce the duration of their balance sheet, which means that they're going to continue to emphasize shorter-term securities, which is curious because that's the interest rate that they can control, that the Fed can control. So if they're really interested in thinking about reducing interest expense on the now $38+ trillion national debt, it's a kind of a clever way to do it, to continue to manipulate balance sheet holdings into shorter-dated securities, and then you can do QE again if you need to. And I think that they may ultimately manipulate mortgage rates lower by possibly doing quantitative easing when the environment calls for it, to get mortgage rates down. One of the biggest problems Jay Powell correctly talked about, and the inflation level has come down, but the price level is still very, very high versus 5 years ago. That also bleeds over into housing affordability, which is really bad compared to where it was 5 years ago. Home prices have gone way up, and mortgage rates are also higher than they were. And so it's just possible that they might want to buy mortgage-backed securities and get them to an even lower yield versus Treasuries. I suspect that might be in the offing, not in the near term, but the intermediate term. And so we're quite positive on the agency-guaranteed mortgage-backed securities market, in spite of the fact that has done very well in recent months, now having more excess return versus Treasuries than investment-grade corporate bonds, which have also done well. So it's been a great year for financial assets. A lot of that had to do with the Fed assumption of more Fed cuts. I would say that assumption is getting a little weaker after today's press conference.